What if I told you the biggest problem in AI for banks isn't building the model? It's everything that comes after. Because right now, if you walk into any bank, fintech, or even a startup trying to disrupt finance, you will see something interesting. AI pilots everywhere. Proofs of concept everywhere. Demo dashboards that look impressive, fraud detection models, credit scoring models, chatbots, even agentic AI experiments. But very few of these systems actually scale, and even fewer survive regulatory scrutiny. So the question is not, can we build AI? The real question is, can we trust, govern, and sustain AI at scale in one of the most regulated industries on the planet? That's what today's episode is about. Welcome to the Change Dude podcast. I am your host, Saeed Rafay. And today, we are going to talk about the risk management problem with AI in banking. Because if you zoom out, the future of AI in banking is not a technology problem anymore. It's a risk management problem, a governance problem, and honestly, a discipline problem. And in this episode, I want to unpack something that most people are not talking about deeply enough. Why scaling AI in banking is becoming harder than building it. Why regulation is not slowing AI down, but actually reshaping how it gets built. And why the real winners in the next 5 years won't be the smartest engineers. They will be the organizations that master model risk. Let's start with a shift that's already happening quietly across the industry. For the past decade, AI in finance was driven by innovation. Who can build the best model? Who can detect fraud faster? Who can predict credit risk more accurately? But now something has changed. Regulators, central banks, and supervisory bodies are asking a different question. Not how accurate is your model, but can you explain it, govern it, and defend it? And this is where things get uncomfortable. Because modern AI, especially machine learning and large language models, is inherently complex. Sometimes even the creators don't fully understand how decisions are made. But regulators don't care about that excuse. Under existing frameworks like Federal Reserve guidance on model risk, banks are already required to fully understand, validate, and monitor any model they use. And here is the key insight. These rules were written in 2011, long before generative AI, long before agentic systems, and yet they still apply. In fact, they are becoming even more important. Because according to recent industry analysis, AI adoption in banking is increasingly shaped not by innovation, but how well models can be governed, explained, and defended under existing regulatory frameworks. Let that sink in. We are not waiting for new AI laws, we are using old risk frameworks to control new intelligence. Let's simplify this. Model risk is the risk that a model gives you the wrong answer or that you use it incorrectly. That's it. But in banking, that wrong answer can mean a loan denied unfairly, a fraud case missed, a compliance violation, or billions in financial loss. That's why model risk has always existed. But AI just amplified it. Because AI models are more complex, more dynamic, more opaque, and used in more critical decisions. According to supervisory guidance, model risk increases with complexity, uncertainty, and impact, which perfectly describes modern AI systems. And here is the real problem. Traditional models were static. You built them, validated them, and deployed them. AI models don't behave like that. They evolve, they drift, they adapt. Sometimes they hallucinate, and now with agentic AI, they don't just predict, they act. Now let's talk about where things start breaking. Banks still rely heavily on model risk frameworks like SR 11-7. These frameworks require rigorous validation, documentation, governance, and monitoring, which sounds great in theory. But here's the tension. These frameworks assume models are stable, inputs are predictable, Outputs are explainable. AI breaks all three. Modern AI systems can change behavior over time. They can rely on unstructured data, they can produce outputs that are difficult to interpret, and they can be reused across multiple use cases, sometimes in ways that were never intended. This creates something new, not just model risk, but systemic AI risk, because now you are not just validating a model, you are validating an ecosystem. And according to recent guidance, banks are now expanding their definition of a model to include AI systems, automated decision engines, and even third-party AI services. Think about that. Even an API call to an external AI provider becomes a regulated entity. That changes everything. So let me challenge a common belief. Most people think the bottleneck in AI is technology, better models, better data, better infrastructure. That's outdated thinking. The real bottleneck is governance. Because here is what banks actually struggle with. Keeping track of all AI models across the organization, validating them independently, documenting how they work, monitoring them in real time, managing third-party dependencies, and ensuring compliance across jurisdictions. This is not a machine learning problem, this is an organizational problem, and it's expensive. That is why smaller fintechs are starting to feel the pressure, because building AI is becoming cheaper, but governing AI is becoming more expensive and more complex. Now let's talk about the future, agentic AI. Systems that don't just assist, but take actions, approve transactions, execute trades, interact with customers autonomously. This is where things get serious. Because traditional risk frameworks assume human oversight. Agentic AI challenges that assumption. Now the question becomes, who is responsible when an AI agent makes a decision? The developer, the bank, the vendor, the model itself? And more importantly, how do you validate something that behaves differently in every situation? Recent research shows that agentic AI systems behave more like complex adaptive systems, where risks emerge over time and across interactions rather than from a single model failure, which means your current validation process might not even detect the real risk. Then there is another problem that doesn't get enough attention: model drift. This is when a model becomes less accurate over time because the world changes. Customer behavior changes, market conditions change, fraud patterns evolve, and suddenly your model is no longer reliable. But here is the scary part. Most organizations don't detect drift early enough. And in AI systems, drift is not a bug, it is inevitable. That's why modern model risk management now requires continuous monitoring, not just one-time validation. Because in AI, deployment is not the end, it is the beginning. So let's zoom into something even more practical. Who is actually managing all this? Because building AI requires engineers, but governing AI requires something else. People who understand regulation, risk, data, models, business context, and communication. This is a rare combination, and it is becoming one of the most valuable skill sets in financial services. In fact, many organizations are now realizing that their biggest gap is not AI talent, it is AI governance talent. People who can bridge the gap between innovation and compliance. Now here is the interesting part. Everything we discussed so far sounds like a problem, but it's also an opportunity because the institutions that master model risk will move faster than everyone else. Why? Because they can deploy AI with confidence, they can scale without fear, they can pass regulatory scrutiny, and they can build trust with customers. In fact, recent guidance suggests that strong AI risk management is not just a compliance requirement, but a competitive advantage. And what does that mean? Risk management is becoming a growth strategy. So where does this all lead? We are moving toward a world where every AI system is monitored continuously, every decision is traceable, every model has a life cycle, and governance is embedded into the system itself. In fact, AI is starting to manage AI, using agentic systems to monitor compliance, detect anomalies, flag risks, and even self-correct. But this creates a paradox. You need AI to manage AI, which means you need governance for the governance layer. So let's bring this all together. The future of AI in banking is not about who builds the best model, it's about who manages risk the best. Because in a world where models are complex, regulations are evolving, and systems are becoming autonomous, the real challenge is not intelligence, it is control. And the organizations that understand this early will not just survive the AI wave, they will define it. So if you are building in this space, or leading teams, or thinking about your career, start asking a different question. Not how do I build AI, but how do I govern it? Because that's where the future is, and that's where the real leverage is. Thank you for listening to another episode of the Change Dude podcast. I'm your host, Saeed Rafay, and I'll see you in the next one.